2. Lance Brightstein, Beyond Trading Success. Lance Brightstein did not grow up in poverty, but his family's financial problems impacted his childhood. This early experience instilled in Brightstein a strong desire to avoid similar circumstances when he grew up, and was the seed of his eventual stellar success. In college, he was laser-focused on excelling academically so that he would be well-positioned to land a career that would assure financial security. By the time he graduated, he had decided that a trading job would be an ideal match for his goals and personal strengths. He was so intent on pursuing a trading career that he turned down a job offer at 4 times the starting salary to accept a low-paying job at Trillium, a proprietary, prop, day trading firm. Brightstein got off to a poor start, losing money consistently, albeit in small amounts, perhaps an indication that even as a complete novice, he had an instinct for capital preservation. Although Brightstein had started registering positive returns by that time, after his first year and a half, he was so concerned about his lagging performance that he started looking for other positions. At the same time, he was still putting in maximum time and effort to succeed at trading. By the end of his second year, Brightstein had transitioned to consistent profitability and never looked back. By his 4th full year at Trillium, Brightstein was one of their top 10 traders, a position he retained thereafter, ultimately becoming their best trader ever. Brightstein stayed with Trillium for 10 years. During that time, he generated $46 million in net profits as a day trader. His estimated account size during that time ranged from $100,000 to $3 million, with buying power 4 times these levels. Based on his estimated account size for each year, his average annual return was 263%. Even using buying power as his account size, a very conservative assumption, his average annual return was 66%. After leaving Trillium, Brightstein switched to trading his personal account. In this account, Brightstein shifted his focus from pure day trading to a greater emphasis on multi-day trades, an approach that proved even more remunerative. In 5 years, Brightstein earned $71 million in trading profits in this account on net deposits of $5 million in the first year, with net withdrawals of $29 million in the subsequent 4 years. Conventional Wall Street wisdom is that day trading is particularly ill-advised because the shorter the time frame, the larger transaction costs will be as a percentage of potential gain. Brightstein, however, confidently states that shorter-term trades have the greatest edge, an opinion given weight by his superb day trading record at Trillium. Which view is correct? They both are. For most traders, the standard advice will be valid. The more significant impact of transaction costs in day trading will lead to net losses over time. The difference is that Brightstein developed techniques that allowed him to identify those trades and those points in time where there was a significantly greater probability that the next short-term price swing in a stock would be in a given direction. So, there is no contradiction. If your trade entry timing is exceptionally precise, then perhaps the greatest edge is in short-term trades. But few traders will have Brightstein's trade entry skill. Notwithstanding his incredible trading success, Brightstein's current goal is to move away from trading. The reasons why are discussed in the interview. Where did you grow up? In New Jersey, just outside of New York City. When you were in high school, did you have any idea what you wanted to do with your life? I had no idea what I wanted to do, but I knew I wanted to get a white-collar job, and I understood that education was an essential step in achieving that goal. My dad left for work in New York City at 6 a.m. He ran a dry cleaning store on the Upper West Side and didn't get home till 8 p.m. He did that 6 days a week. My dad eventually became a used car salesman and felt lost in his final years. He died when I was 26. His example instilled in me a powerful work ethic, but I didn't want to live my life going through that type of struggle. My family had difficulties with money. The Great Recession in the late 2000s was particularly stressful financially. My parents tried their best to shield my brother and me from their worries about money, but I could see the misery that the lack of money caused them. As a kid, the lesson I learned was that monetary success equals happiness. That childhood experience gave me the hunger to succeed. I had a chip on my shoulder and a drive to keep going when so many others quit because I did not want to struggle like my parents did. Where did you go to college? Indiana University. How does a kid from the New York City area end up in Indiana? It was the best school where I got a full-ride scholarship. They have an excellent business school, the Kelley School of Business, and by that point, I knew I wanted to do something in business or finance. What was your major? Finance. I was in college during the 2008 Great Recession, which impacted my family financially. It was clear to me that I had to excel. So even though Indiana is a big party school and everyone was having fun, I was intent on getting a 4.0 and hitting the ground running after graduation. How close did you get? Damn close. I had 1 A- in 4 years of the honors program. I graduated third out of a class of a couple of thousand. When did you develop an interest in the markets? In my sophomore year, I read The Neatest Little Guide to Stock Market Investing by Jason Kelly, which highlights the power of compounding money in the market. I also read the first Market Wizards book. I didn't even know that world existed. What appealed to me was that you had interviewed traders with diverse backgrounds and strengths, and they all found their unique way to beat the market. I am a smart person, but there are different levels of intelligence. I knew I wasn't a genius. I wasn't going to MIT for a computer science or math degree. Your book highlighted that you don't necessarily need to be a genius to succeed in the markets because there are so many ways to find success. In my junior year, I joined the investment management workshop at the Kelley School of Business, which prepped students from the Midwest to break into Wall Street. The program detailed the different types of jobs and taught you how to interview, prepare your resume, and network. Coyle speaking. We had a similar program at Ohio State. We managed a multi-million-dollar portion of the endowment as part of the program. They flew us to New York, and we met with multiple firms, but no one cared because we were Ohio State guys. Yes, it was exactly that type of program. We also did the New York trip where people didn't care because we were from Indiana University. We fared a bit better on our trip to Chicago due to proximity. Did the program help you decide what job to look for when you graduated? Through the program and my independent research, I explored the different types of financial firms to determine what kind of job I was best suited for. Based on my research, I decided I had characteristics that were a good match for being a trader. What characteristics specifically? I was hungry and competitive. I was willing to put up with failure and adversity. Also, the culture of large firms didn't appeal to me. I wasn't comfortable with bureaucracy. I didn't want a job where you had to wear a suit and tie every day and work your way up the ladder. At the more traditional firms, you would get placed on a team and work your way up. You would start as a junior analyst, get promoted to analyst, and then finally become a trader. In contrast, the day trading world was trial by fire. It was all on your shoulders. Based on my experiences with group projects in college, I knew I didn't like team structures. In college group projects, I ended up being the one carrying the whole team because I was the one who needed the A. The other students didn't need the A like I did, so I was doing all the work and everyone would get an A. I didn't want to do that anymore. I wanted to outwork everyone else and bet everything on myself. When you graduated, did you restrict your job search to small trading firms? No. I interviewed for any proprietary trading or sales and trading job out there. What was your best job offer? I had a sales and trading offer from the Bank of Montreal for $100,000 plus, which was a life-changing amount of money for me. What was the exact job role? It would have been a rotational development in sales and trading where you were placed at different bank desks before being assigned to a permanent department. Would it ultimately have led to a sales or trading position? Either. But even on the trading side, it's not a true trading position. You're executing trades for clients, not making directional bets. What happened with that job offer? The Bank of Montreal position was an exploding offer, a job offer with a short expiration date. For someone with my background, there's no way you can turn down an offer like that without a bird in hand. This meant I had only a couple of weeks to secure an alternate position. I had done a first-round interview with Trillium, a prop trading firm, and I was in a waiting period with them. I called them and said, I have an exploding offer with another firm. I want the Trillium job more than anything out there. Is there anything you can do to get me in for a final round interview? I will fly out immediately because if I get this job, I'm taking it on the spot. One of the higher-up managers at Trillium liked my enthusiasm to work there and slotted me in for a follow-up interview. The interview went very well, and the rest is history. What was the salary at Trillium? $26,000. That's very low. What was it about Trillium that made you willing to turn down a competing job offer that was 4 times higher? I had researched discretionary intraday trading firms, including Trillium, and discovered that there were people like me making money trading. As I spoke to people at the firm, I realized that many did fail, but that was fine. I didn't mind the high failure rate. I was not scared away by the fact that 70% of people fell out. That was okay if it was offset by what happens if you didn't fail. What mattered to me was that there were people making money every year and even every month. The top 10 traders were making $1 million+ a year, year after year, and they were in their 20s or early 30s. For me, that was the dream. If there were traders who were achieving that kind of success with a consistency that demonstrated that it was not a matter of luck, I wanted the opportunity to see if I could do it as well. I was trying to determine the long-term expected value of my working at Trillium versus the Bank of Montreal. Was the compelling factor finding empirical evidence that it was possible to beat the markets? Yes, not only seeing that it was possible, but seeing that it was possible even if you weren't an MIT math graduate. Did you get that empirical evidence by talking to people at Trillium? Yes, any firm will tell you that it is a great place to work. I wanted to speak to the people who worked there. How did you find these Trillium employees? A forum on a website called Wall Street Oasis had some Trillium traders on it. I contacted them, and they were willing to have a phone call. I learned as much as possible about the firm's culture and whether it was a legitimate opportunity. I had heard that many prop trading firms were bucket shops where you had to put up your capital. Not only did I not have capital, but I wasn't going to waste my time when I had a $100,000 job offer. What convinced you that Trillium was not one of these shady firms? It was speaking to these Trillium traders. I tried to get as much data from them as they were willing to give me. What was their success rate? What did the top 10 traders in the firm make in a good year? What did they make in a bad year? I wanted to get an idea of the distribution of success. I didn't need to be guaranteed success. I just needed to know that it was possible and that there were people there who were succeeding. Besides determining that there were traders at Trillium who were succeeding, what else did you learn in these conversations? As I spoke to traders at Trillium, it became clear that a standard set of characteristics and skills led to success. It came down to hard work and resilience through a long learning curve. The Trillium offer was much lower, $26,000 versus $100,000 plus. Did you have any difficulty making that decision? I had no difficulty because I wanted to go for it all. I recognized the value of delayed gratification at an early age. This example may seem silly, but there are certain strategy-focused video games where the more you postpone spending, the more resources you have later in the game, and the more likely you are to win in the long run. The job choice was similar. Yes, I will be sacrificing $75,000 for 2 years, but if I were successful after that, I could make $1 million a year. Although I had no difficulty deciding, everyone around me told me I was an idiot. I remember speaking with the recruiting person from the Bank of Montreal who was pursuing me aggressively at that point. He said, "You can't make money day trading." A helpful mentor from the Wall Street Prep program in Indiana, who had built out an Asian trading desk for Salomon Brothers and then worked at a hedge fund for years, advised me, "Lance, if you work for a conventional firm, you'll get a good education and training and build a solid network. If you do it steadily, you'll have a conservative path to success." He was very skeptical whether anyone could make money day trading. Also, people knew about the poor reputations of many prop trading firms. A lot of them are bullshit. But I had done my research and found that Trillium wasn't one of these firms and that some people there were succeeding. So I ignored the advice. Turning down the much higher-paying Bank of Montreal offer and ignoring the advice of mentors, were you that confident you would succeed as a trader at Trillium? I wasn't confident that I would succeed, but I was highly confident that I would outwork everyone at that firm. That was the only thing I had no doubt about. I know you were confident that you would be the hardest worker, but what gave you the confidence that you would succeed in trading? Although most successful traders are hard workers, the reverse is not necessarily true. Being a hard worker doesn't assure trading success. Many people who are hard workers still fail at trading because they don't have the requisite skills or the right emotional makeup. What gave you the confidence that trading was something you could succeed at? I didn't necessarily have the confidence. I just loved what the job looked like and being able to compete at that game. Here's the paradox. No one who takes the Trillium job thinks they will be in the 70% that fail. Most of the people taking the job have previously excelled in some pursuit. They may have been a Division I athlete or a professional video game player or a highly ranked chess player or had a 4.0 GPA. Most have some standout accomplishment and expect to succeed. I didn't expect to succeed more than anyone else. How did you make ends meet with $26,000 in New York City? That's a great question. The top trader at the time had twins and left the city to raise his kids in Princeton, New Jersey. He opened a little satellite office there. 2 people were hired for that satellite office and 1 reneged, which meant there was an opening at the satellite office with the top guy. No one else wanted to give up the fun of being young in New York City to go to Princeton. But for me, it was the biggest no-brainer of my life. All I cared about was learning from the best person. I immediately applied and interviewed for the job and got it. That is how I ended up working for the top trader in the firm. I lived in a rental near Princeton, which I shared with 3 roommates. My portion of the rent was only $400. Also, I had built up savings in college through an energy trading internship at BP, working as a lifeguard, and doing pool maintenance during the summers. The nice part about a low salary is that it leaves you with no money to get yourself in trouble and enough hunger so that all you do during the week and even on the weekend is work. Years later, as a manager at Trillium, I was always a proponent of not raising the salary too much for new traders because there is a motivational effect and a sense of urgency in being financially restricted early in your career. I remember how tired I got of eating like a New York City sewer rat. I ate the $5 footlong Subway sandwich every day for 4 months, and that would be 2 meals for me. I had half the sub for lunch and half for dinner. I didn't want to eat Subway sandwiches ever again, and that would only happen if I made more money. I didn't have money to go to bars or movies, so I stayed in the office and worked late. You said before that the number of traders who failed at Trillium was around 70%. I'm surprised it's not a lot higher. That's because Trillium recruits hungry, qualified people and has excellent mentorship and training. In other words, they're atypical, and their 30% success rate is not representative of other prop firms. We have talked about Trillium being a day trading firm. Weren't there traders who wanted to hold positions for a few days or at least overnight, which is still short-term trading? Yes, experienced traders could hold positions for a few days, and Trillium did have a couple of longer-term traders. But 2 factors drove almost all the trading to be day trading. First, the owners of Trillium were instrumental in inventing electronic trading in the late 1990s. The firm has always prided itself on having the best technology for fast intraday trading. I would argue that Trillium has the fastest human traders in the world. Having software that was optimized for fast trading results in traders gravitating to day trading. Second, I would argue that the returns on intraday trading, especially adjusted for risk, are unmatched. There are traders at Trillium who will go on 200-day positive streaks. There are traders who virtually never have negative months. You don't get those return profiles on longer time horizons. Why do you believe that day trading has an edge? Day trading has an edge because there will always be micro inefficiencies of all kinds. As a simplified example, say there is a news headline in which Apple announces that they sold 15% more iPhones than expected. If you are one of the fastest traders to transact on that story, you can execute an incredibly high expected value trade because the probability that Apple will go down after that type of story is minuscule, while the upside is substantial. Or, as another example, if there's a headline that a stock that is trading at 15 is going to be acquired at 20, and you're one of the first traders to respond to that news, the probability of a win on that trade is nearly 100%, unless you misread the story or made some other error. I was under the impression that many algos are programmed to react to keywords and headlines, and they can beat the fastest human. Why wouldn't that interfere with the trade examples you just cited? I often ask myself the same question. Algorithms have entered the game, and there are certainly algos operating in some merger and acquisition headlines. But a lot of these algos are not very nuanced. They won't have the same level of sophistication as a skilled day trader who can factor in the context of the headline. Is it a reported fact or a mere possibility? Was the reported news actually less bullish or bearish than previously anticipated? Is it even new information? Does the prevailing market sentiment or momentum change the interpretation? For now, there's still a huge gap that can only be filled by human insight, intuition, and judgment based on thousands of data points that an experienced day trader would have witnessed. Take, for example, a tweet by President Trump. An algo would have a harder time interpreting that than a knowledgeable trader would. There are a lot of news headlines where the algos cannot execute trades properly. But isn't a headline like Apple reporting better than expected earnings exactly the type of headline that an algo would pick up on and instantaneously buy faster than any human trader could? You have a valid point that I cannot fully counter because I have also wondered why more of these trade opportunities haven't been eliminated yet. I don't have a good answer. All I can confidently say is that these opportunities still exist. What kind of order do you use when you enter one of these headline trades? If you use a market order, you might get executed way beyond where the market is when you place the order. On the other hand, if you use a limit order, you might easily miss the trade. How do you bridge that divide? A critical part of being a day trader is creating optimized hotkeys for every possible situation. I virtually never used market orders. Instead, I would use some configuration of a limit order. You could configure that order as a hotkey, meaning if you press the key, it would immediately send that order to the market. There are so many keys on the keyboard, you can create unlimited combinations of hotkeys by using different combinations of keys like Shift, Control, and Alt. I would know that for a given type of headline, I was willing to pay 1, 3, or 5% through the offer. I would know whether I wanted to buy 500, 5,000, or 50,000 shares. I had all these different key combinations, with some hotkey being close enough to the order I wanted to do. So you might have a hotkey that would buy 5,000 shares limited to the offer plus 3%. Exactly. Was knowing the right amount over an offer you are willing to pay a matter of research? Because if you are too low, you will miss trades constantly, and if you are too high, you'll end up paying too much. Absolutely. What was your first impression when you were exposed to trading after joining Trillium? I have a twin brother. When we were kids, we played video games all the time, and I got very good at them. With the advent of online gaming, I could compete with people from all over at these games. If there were electronic gaming leagues back when I was a kid, as there are today, I might never have even made it to college because I loved video games that much. And what I saw at Trillium was that you were essentially playing a video game against the whole world. Here was this super complex puzzle. There are many ways to win, and you're competing with everyone. Best of all, the financial stakes are high, and, as a bonus, you don't need to wear a suit. I loved the complexity of it and the thought of trying to beat all these people at this electronic game. I loved the idea that my success rested entirely on my shoulders and didn't depend on what anyone else did. Did the video game experience help you as a day trader? Absolutely. Video game backgrounds are common at Trillium. There have even been some competitive gamers who have had careers there. When a headline comes out, the difference between being the first to trade on it and the 10th could be $100,000. It could be the difference between a win and a loss. I would do everything possible to shave tenths of seconds off my speed. For example, for the Canadian interlisted ticker CGC, you would need to type CGC.T, the .T being for Toronto, and then press Enter. I downloaded software that allowed me to replace the .T and Enter with a single keystroke like a semicolon. I even optimized my screen setup to minimize eye movement by placing the streaming headlines right next to my level 2 boxes, detailed listings of bids and offers. What was your experience like when you first started trading? As I mentioned, I was working for the top trader then, and it was an incredible mentorship. I already knew basic technical analysis, but this trader was an expert in nuances and technical patterns. He had stacks of notebooks with meticulously annotated charts. He had defined all these multi-day patterns, which included factors such as where the close was relative to the daily range and the associated volume patterns. He also incorporated factors like where prices were relative to the Bollinger Bands, the angle of the moving averages, and so on. People ask, why can't academia find an edge in technical analysis? My answer would be that they're not applying it appropriately with enough nuance and specificity. Most patterns are indeed noise, but when you align enough nuances, there are very specific moments in time that provide tremendous positive expected value. It sounds like he had defined a multitude of different patterns, where a pattern wouldn't be just something simple like a price breakout, but rather a breakout that occurs with some specific volume or volatility characteristics and perhaps some specific price pattern before the breakout. So maybe breakouts alone aren't a reliable signal, but if you combine them with other technical inputs, you can identify the breakouts that are more likely to be valid signals. Precisely. How do you avoid the false breakouts? Some factors will increase your odds. What if there is a breakout on multiple time frames? What if this is a breakout on a news catalyst? What if it is a breakout when there is high short interest? Let's take the example of the Bitcoin breakout following the U.S. presidential election of November 5, 2024. It was a breakout to all-time highs on a news catalyst, the victory by a candidate hugely supportive of crypto in a security with a highly reflexive feedback loop in which the higher the price goes, the more buying interest there is. Also, before the breakout, the market had formed a pattern of higher highs and higher lows against the $75,000 resistance level. The breakout in Bitcoin was one of the best setups of the year because all those elements aligned. Is one general lesson that patterns are more powerful if there is a news event in the same direction? I generally want to be trading in the same direction as the price swing triggered by the news. News often increases the probability of a trade working. I rarely want to fight the news. If a stock has an extreme move, I will be far less likely to look for the trend to exhaust itself and reverse if there is news behind it. It sounds like the top trader you sat next to greatly influenced the trading style you developed. He had a massive influence. I don't know if I would have had a trading career without him. Was it a matter of learning the particular patterns he was using, or learning to think like he did, namely looking for multiple characteristics to define an effective pattern? Both. Were you net profitable in your first year? Not at all. I lost money for 11 consecutive months after I started and was still net negative cumulatively into the early part of my second year. I knew I needed to experience more repetitions of real-world situations, so I recorded my screens and then, on nearly every Sunday for 10 years, I would go into the office to rewatch trading sessions. If you were recording your screens in real time, how could you have enough time to rewatch the trading sessions on the weekend? I didn't rewatch the whole session. I kept notes on which moments were the most critical points each day. At the end of the week, I might have 6 or 7 short video clips that I could rewatch. And what's so cool is you can slow down those video clips. I can't slow down real time when I'm trading. When I take a video of it, I can study what happened at half speed. I can also practice trade that moment at 2x speed. Just like baseball players might put a weight on their bat when they are practicing so the bat feels lighter in a game. I practiced trading some of these fast opportunities at 1.5x or 2x speed so that real-time trading felt slowed down. Given the consecutive losses at the start of your trading career, did you ever start to doubt yourself and think that maybe you weren't cut out to be a trader? Yes, of course. It was incredibly frustrating because I hadn't failed at anything before. Here I had found something I loved, and there was nothing more in the world I wanted to succeed at. I saw the input I was making. I was working harder than everyone else, but the output was garbage. I was losing money. At what point do I have to admit that maybe I'm not one of the people that's going to make it? I needed to have a backup plan. So, after about 18 months, I started to interview elsewhere. How much were you behind in the first 18 months? By then, I was slightly above break-even in my trading, but I was still a net loss to the firm, even at my low salary. How did you hold on to your trading position despite your lackluster performance? To Trillium's credit, they're good about giving traders a long leash at the start of their career. They have data that shows that some people who are ultimately successful are slow bloomers. Also, the monthly costs of keeping someone on are small compared to what traders can make the firm if they succeed. It's an asymmetric proposition for them. A lot of people in my starting class of traders had given up and quit. One thing that helped me specifically was that while I wasn't able to execute in real time effectively, I was at least improving enough so that I was able to spot good opportunities and help the other people in the group make money. Give us an example of how you came up with an idea that other traders made money on, but you didn't. I did a study on hot IPOs that closed strong in a bull market, which showed that there was a lot of positive momentum overnight. I don't know if that data still holds. You're not allowed to take overnight risks during the first couple of years, so I couldn't trade those IPOs overnight, but others on my team could. You sat next to this trader, who you said was a fantastic mentor, yet you were only at break-even in your first year and a half. What were you doing wrong? My boss was an expert, and it wasn't like, here, start with this one simple strategy. It was more like, here's the fire hose, figure it out. Also, in intraday trading, trades happen very quickly, in minutes or even seconds. It took a while for me to integrate everything I was taught and to learn to analyze and respond quickly enough. Are there any losses from your early trading years that stick in your mind? Yes, I had a super fat tail loss that almost ended my career. It happened in 2014 after I had become a net profitable trader, but still relatively early on. It was a trade in Allergan, AGN, a large pharmaceutical company. The stock was going up multiple days in a move that was unusually large for a large cap, and then one day the stock really shot up into the close. The price action suggested that someone had been trying to put on a large position over the past few days and finally capitulated on that last day to fill their entire intended position by the close. At this point, I was allowed to take overnight positions. Based on my hypothesis that the big buy order was complete, I placed some Hail Mary sell orders well above the market. What ended up happening was that a news service we didn't have in our office released a story about Bill Ackman trying to engineer a hostile takeover of Allergan. The stock exploded after hours, and my offers got filled for a few thousand shares. I lost about 100,000 when my loss limit was 4,000. Did that loss so far beyond your risk threshold endanger your job or engender any serious reprimand? No, I was insulated because I was at the Princeton office with my boss. And the truth is, while I'm sure they weren't thrilled with me, a reprimand isn't productive in those situations anyway. Everyone knew I was trying my best and giving the job everything I had. There was nothing I could have reasonably done differently. It was a fat tail event, and we didn't have access to the headline that got us. Many in the firm took the same loss. The beauty of these firms is that incentives are very well aligned. I wanted to keep my job and make money, and they knew I would do everything in my power to learn from that lesson and never expose myself to that risk again. Was there a transition point between losing consistently and then winning consistently? It wasn't a matter of one change. The reality is that it was the sum of many small nuances I was incorporating in my trading. My decisions were getting marginally better. I was avoiding several mistakes each week. But there was one standout trade that made a significant impact on me. It was a short in Tesla, TSLA, in 2013 based on an exhaustion gap pattern. At the time, I figured I only had a few months left at Trillium if things didn't turn around. I had already started looking for another job just in case. I was beginning to be more willing to take risk because if you're at the end of the rope, you might as well go out in a blaze of glory. Then, this exhaustion gap pattern set up in Tesla. This pattern is based on a daily chart. Unlike the fast trades we discussed, this was a plannable trade. I made $10,000 that day. I thought, I did it. I bought myself some time. But the more significant lesson was that my boss next to me probably made a couple $100,000 on the same trade. I made the same trade he did, but he made 25 times as much. I realized I did what he did. The only difference was the size. If he could do this stuff, so could I. That was a big epiphany, the realization that I could do this. Can you define what you mean by an exhaustion gap? An exhaustion gap is a multi-day pattern that can occur on the upside or downside. In the case of Tesla, it was an upside gap. It is a euphoric move on high volume that culminates with a price gap on the final day. On day A, the market moves up on high volume. See Chart 2.1. On day B, the market has another big up move on high volume. On day C, the market has a third consecutive large up move on high volume. Finally, on day D, there is a wide upside gap at the open on even higher volume. That is the day of pure euphoria when everyone who is short or looking to buy capitulates and buys indiscriminate of the price. The trend exhausts itself and prices begin to retrace. That is the day I am looking for a major price reversal. Another example of an exhaustion gap is MicroStrategy Inc., MSTR, on November 21, 2024. See Chart 2.2. I apply technical analysis exactly the same way for shorts as I do for longs. For an exhaustion gap buy, I would look for the same pattern in reverse. Of course, there is the difference that the upside is theoretically unlimited, making shorts more dangerous, while the downside exhaustion gap can only go to zero. What time frames do you use in your chart analysis? For intraday trades, I use a 2-minute bar intraday chart. I also use 3-month and 3-year daily charts for a broader perspective. The intraday chart has always been the predominant chart for me. Roughly speaking, intraday charts drive 70% of my trading decisions, whereas longer-term charts account for the other 30%. Do you interpret price patterns on the 2-minute chart in the same way as price patterns on the daily chart? Yes. The time frame of the bars on the chart makes absolutely no difference in how you interpret the chart? Correct. I would trade the same pattern the same way. Of course, some patterns like an exhaustion gap are more readily expressed on a daily bar chart because you can't get a gap on an intraday chart unless the ticker halts for excessive volatility. When a trade is based on the daily chart, ideally, I still want the price action in the daily and intraday charts to be aligned, and I use the intraday chart to time the trade. A good example was buying the capitulation in Nikkei futures on August 5, 2024, which was the biggest trade of my career. Triggered by short covering in the yen, the Nikkei saw panic selling, resulting in one of the largest 3-day moves ever. Nikkei volatility and the size of the price move even exceeded the peak panic during COVID, which screamed to me that the August 5, 2024 panic likely represented a massive opportunity. Is short covering in the yen even remotely as scary or as fundamentally damaging as the COVID impact? It sure seemed unlikely. The selling on August 5th was accompanied by huge volume. My strategy is to buy capitulation panics, initially using a stop at the day's low, and then using a trailing stop below the prior day's low. Chart 2.3 depicts the Nikkei futures daily chart and Breitstein's entry and exit on the trade. The intraday chart showed the same accelerating sell-off. See Chart 2.4. I generally wait to buy until the market has formed a V-bottom on the intraday chart, signaling that the panic has run its course. This panic, however, was so severe that I wanted some exposure before the turn. This initial long position was stopped out because the market went to new lows. When the Nikkei subsequently rebounded off the lows, I reestablished my long position shortly thereafter. So far, we've talked about exhaustion gap and capitulation trades. What are some other types of trades you do? Another type of trade I do is what I call a bouncy ball short. If I drop a ball, each time it bounces, it rebounds less and less, making a series of lower highs. An example of that type of trade was Nikola, NKLA. The stock had run up, and then a negative earnings report was released. As a result, it had the potential to make an outsized move. The stock cracked lower in the pre-market and then formed a double bottom after the open, with the low of that pattern establishing support. It then formed a series of lower relative highs above that support. My sell point was the breaking of support. See Chart 2.5. I then used an initial stop at the prior support level, followed by a trailing stop above the high of the prior 2-minute bar. This simple trade netted a $7 per share, split-adjusted, profit in less than 30 minutes. A related trade is the inverse bouncy ball breakout. As the name implies, this pattern consists of a series of higher relative lows below a resistance level, followed by a breakout above that level. The election day breakout in Bitcoin we discussed earlier provided a perfect example of this pattern. I entered on the breakout and used a trailing stop below the prior day's low. Chart 2.6 depicts the Bitcoin chart and Breitstein's entry and exit on the trade. Are there any other examples that illustrate a type of trade you do? As we discussed earlier, many of my trades are triggered by headlines. The skill set for these types of trades entails having the experience to recognize which headlines are material to the price of a stock and the ability to process and act upon the headline very quickly. An example of a breaking news short was Supermicrocomputer Inc., SMCI, on August 28, 2024. As background, there were allegations by Hindenburg Research that SMCI's accounting practices were fraudulent. Then, breaking news came out that SMCI's auditor had resigned. My strategy for these types of trades is to initiate a position as quickly as possible after processing the headline and then use a trailing stop above the high of the prior 2-minute bar. Chart 2.7 shows Breitstein's entry and exit on this trade. An example of a breaking news buy was President Trump's announcement on January 21, 2025, of the Stargate AI project, a new multi-company venture in which Oracle, ORCL, was one of the participating companies. This announcement occurred in a market that was particularly responsive to AI news and anything favored by the new Trump administration. The trade was to buy Oracle as quickly as possible using the low of a 2-minute bar trailing stop. Chart 2.8 shows Breitstein's entry and exit on this trade. We have discussed multiple types of strategies that you employ: reacting to breaking news, countering euphoria and capitulation, and identifying predictive price patterns. Does any of those account for most of your profits? It depends on the market environment. In a year like 2018, we had lots of market-impacting headlines, including President Trump's tweets and many mergers and acquisitions. I was able to trade all those headlines extremely well. In a year like 2020, there were numerous panics and capitulations, so those trades became the major profit opportunity source. Do you always have a stop predetermined when you enter a trade? Not always, but more than 90% of the time. There are situations where the panics are so extreme and so capitulatory that the likelihood of the stock rebounding with high probability outweighs the risk of not having a stop. But if you don't have a stop, you need to size the position far smaller. In that type of situation, I might put on a small position without a stop. However, I won't consider buying an extreme panic if a news event triggered the sell-off. If there is breaking news, I almost always want to be in the direction of the price response to the news. How do you decide how much you will risk on a trade? For my personal account trading, I think in terms of the dollar loss after taxes. For example, on the August 5th panic day in the Nikkei we discussed earlier, I made about 10 million and risked about 2 million, or about 1 million after taxes. What percent would that be in terms of the account size? At the time, I had about 40 million in the account, so that risk would translate to about 5% of the account pre-tax or 2.5% of the account post-tax. That was on a trade you viewed as an exceptional opportunity. I assume the risk on a typical trade would be significantly smaller? Yes, of course. I never want to risk my long-term safety and security. Losing it all would dramatically impact my life, whereas doubling my account wouldn't change my life much at all. What was your worst loss ever? My worst loss occurred in November 2021, near the end of my career at Trillium. In 2020, I had set the all-time annual record at Trillium with nearly 17 million in profits. I was set to leave the firm at year's end, and I was hoping to set the bar even higher and break 20 million in a single year. By February 2021, I had already gained 12 million, and initially it seemed inevitable that I'd break the record. However, the rest of the year was terribly slow. As the months ticked by and we approached year-end, I felt my shot slipping away. It was a quiet, inconsequential day on November 2nd when Avis, CAR, started to explode higher on what would later be attributed to a vague mention of the company expanding their electric vehicle fleet after reporting earnings pre-market. This normally boring stock quickly went from 175 to over 300. This euphoric upside capitulation was the exact setup I had thrived on with GME and AMC earlier in the year, timing their peaks to catch the reversal short for some of my biggest wins. I saw Avis as my best chance to break through the 20 million barrier. I shorted lightly into the spike and then added incredibly aggressively as it turned lower, convinced the move had exhausted itself. At first, it looked like a perfect trade. The stock broke lower, and we even had a downside volatility halt that made me think the top was in. But instead of unraveling, Avis consolidated and then reignited for another leg higher. The stock ripped to 385, and I was forced to take my loss as we broke out to highs. In less than an hour, I had lost over 2 million, the largest loss of my career. It's a good thing I got out where I did. Avis kept running all the way to 550 that day after I stopped out. With that loss, I knew I wouldn't be able to recover and achieve my goal. You took a trade that was right in line with one of your key setups, and you liquidated when the market action indicated you were wrong, thereby averting disaster as the stock subsequently skyrocketed. While this was your largest loss ever, did you do anything wrong? Yes, I did. Although the setup itself was right in my wheelhouse and there was nothing overtly wrong with how I executed the trade, my mistake was sizing the trade too aggressively. Because I was anchoring on achieving my 20 million goal, I sized the trade much larger than I should have. What lessons did you draw from this trade experience? A timeless lesson. You can never impose your will on the market. The market doesn't care if you have a mortgage payment due. It doesn't care if you want a new car. It doesn't care if you want to set a new firm record. The market demands you size your trades objectively based upon expected value. At that time, knowing my career at Trillium was coming to an end, I never imagined that I would end up having bigger trading years. Yet, in 2024, I shattered my previous records, completely free from any goals or self-imposed expectations. You have known a lot of traders. Have you known traders who made fortunes and lost it all, or almost all? I haven't directly witnessed that type of situation. However, one of my close friends knows firsthand of a trader who, in 2020, ran a couple $100,000 account up to nearly $1 billion. He begged the trader to take off some risk. Well, the trader didn't take the advice and went from nearly $1 billion back down to about $10 or $20 million. He became despondent. Most people would say you still have $10 or $20 million, which is a lot of money, but he was anchored to his high watermark. Why did you leave Trillium? At the time, I was managing the Chicago office for Trillium, and I didn't want to hire, train, and manage new traders anymore. Could you have opted to just trade your own account and not have any managerial responsibility? They definitely would have let me do that. However, I wanted to continue to grow into larger-scale trading and trade on longer time frames. By that point, I had made a lot of money. I wanted to be free to pursue swing trading. I also wanted to change my daily routine. I didn't think being glued to the screen all day, every day, was a healthy lifestyle. I wanted to free up time to pursue other passions, including my nonprofit work. Can you elaborate on how you wanted to change your trading and how you were being inhibited at Trillium? My general philosophy is that the highest probability trades will occur in the shortest time frames, but that advantage comes at a trade-off to scalability. I had great annual returns at Trillium, but if you had given me $1 billion, I would be returning 1%. The trades I was doing were based on short-term chart patterns and didn't have scalability. As my net wealth grew, I recognized that if I wanted to go into the major leagues and put up even bigger numbers, I needed to start trading longer time frames and expose myself more to even larger trades. What time frames were you looking to do? I was looking to do swing trading, holding for multiple days, maybe a week. At Trillium, was all your trading intraday? 99% of my trades were day trades. If I occasionally wanted to hold something overnight, it was no big deal. However, if I wanted to hold a position with a large portion of my buying power for many nights, it was discouraged. They tried to dissuade you from trading a style that was outside of the firm's focus. Trillium specializes in being the most dominant firm in the shortest human time frames possible. They specialize in trading very short-term inefficiencies. But you were their top trader. Why wouldn't they allow you to expand your scope of trading beyond intraday? The main obstacle was the person running the firm's trading back then. He was inflexible on issues like the amount of buying power allotted to traders. What was your buying power at the time you left Trillium? $12 million at its highest, and I was making over 100% per year on that number. It was a laughably small amount of buying power relative to my capabilities. After I and several other top traders left the firm, the manager of the firm was replaced, and everyone's buying power was increased. How did your trading change after you left Trillium? There were several significant changes. At Trillium, I specialized in trading breaking news headlines. After leaving, I no longer had the technology geared to fast trading. I also wasn't sitting in front of a trading screen all day. I was trying to get more balance in my life and doing lots of other things besides trading. My news trading, which was a huge profit source at Trillium, quickly became obsolete. Also, taking advantage of order flow inefficiencies, which might exist for a second, were no longer possible trades. All the shortest time frame trading opportunities were now gone from my playbook, which was fine. My whole vision was to apply the same concepts I had been using to a longer time frame. I still use the same intraday techniques to time my entry into trades, but I am looking for trades with longer-term holding potential. For example, I entered the long in Nikkei futures, which we discussed earlier, using the same chart analysis and timing techniques I had before. But I put on that trade in much larger size, and I held a third of it using a daily stop rather than an intraday stop. I was able to have my best year by far by scaling much larger and holding longer. I'm about 1% as active as I used to be. Do you literally mean that you do only one trade for every 100 you did before? Yes. Here's the irony. You're trading 100th as often and making 3 times as much. Yes, that's the beauty. What does that say? This past year, I had a much more balanced and healthier lifestyle. I created an elaborate trading course and devoted lots of time to my nonprofit. Yet I made more money than I ever would have made day trading at Trillium. What lessons do you draw from that? One of the most important things in life is, are you playing the right game? I grew up in day trading world, and that's all I ever knew. You can be the best scalper in the world, but liquidity will limit your upside relative to a swing trader. Do you still believe the greatest inefficiencies are in the shortest time frame? Absolutely, but your scalability will be limited. The highest probability trades will be very short term, but your upside will be limited because you can't put them on in size. What % of the days are you trading now? I do a fair amount of selling option premiums, and I'm always watching and keeping abreast of what's going on in the market. But as far as actually trading equities and being more actively involved, I'd say about 20% of days. How do you pick the days you trade actively? I will trade on days when events, which are usually theme-related, are driving market volatility. For example, in 2024, these themes included semiconductors going crazy, AMC, and GameStop when Roaring Kitty came back, the online name of the investor whose postings triggered the historic GameStop rally in 2020, the August panic triggered by the steep rally in the yen and collapse of the Nikkei, geopolitical risk premium related to the Israeli and Iranian counterstrikes, and the Trump election. You mentioned you're an option seller. How do you decide which options you're selling premium on? I have some general rules for option selling. My most important rule is that I never want to be selling volatility when nothing crazy is going on. I never want to be caught in a position before the craziness and volatility. I'm waiting for the extreme moves before I begin selling options. The other important rule is that I sell options at the strike price at which I would want to own the stock. Often when a stock is in a waterfall panic sell-off, there will be a point where if the stock fell another 5 to 10% within a short time period, I would want to buy the stock. I may win on 80-90% of my options trades, but the other times when my short option gets exercised, the sell-off in the stock has been so panicked that I want to own the position. To paraphrase your thinking with an example, if a stock was plunging and was currently at 20 and you wanted to be a buyer if it extended to 17, you might sell the 17 strike puts. Then, if the stock didn't fall to the strike price by expiration, you would earn the premium, and if it fell below the strike price, you would be long at an effective price lower than you were willing to buy it, since you still keep the premium. Yes, 80-90% of the trades would be profitable because the option expired out of the money and I earned the premium. The ironic part is that in those trades where the market fell below the strike and the option was exercised, I often did even better because the stock price decline was so overextended. About 5% of the time, I would take a loss because I was too early in wanting to be long. But generally speaking, I made the most on the trades when my options were exercised. Can you use an analogous strategy by selling out-of-the-money calls when a stock is rallying? Yes, but I will be far more cautious when selling calls. When you are doing something like selling options, especially calls, sizing is the most important thing. Bad trades don't kill people. Bad sizing kills people. My short option positions will be far smaller when selling calls than when selling puts, which benefit from a zero price bound. Okay, I get that your position size will be much smaller when selling calls, but how do you manage the risk on that smaller position when your short call is exercised? Often, when I get exercised on a short call when prices are going wild on the upside, the volatility is so high that selling puts against my short position gives me an incredible cushion. Earlier, you said one of the reasons for leaving Trillium was to have the time to do other things besides trading. What were those activities? After I left Trillium, I focused more on my nonprofit work and started sharing trading knowledge online, looking for the next chapter in my life. I tweeted trading lessons and advice and built up a large following. I've spent the past year creating a trading course that I just launched at theonelanceb.com, as well as a series of free YouTube videos. I donate all the net profits from the paid course to charity. Everyone, me included, gets skeptical when a super trader decides to sell a course online. Why are you selling courses? I agree that trading course sales attract some of the biggest scammers in the world. I've seen these scam artists posing with green Lamborghinis, fleecing people by selling worthless trading courses. Part of my reputation was based on calling out these frauds, Countering these frauds was one of the reasons I decided to start offering free content. I wanted to tell people, don't pay for these bullshit courses by fraudsters who never made a dime trading when I'm offering free videos made by a successful trader. The strong, positive response to those early, low production quality videos got me thinking, why don't I just do this properly? So I spent $700,000 making what I hope will be the greatest trading course ever. Where is this course available? I have a website, theonelanceb.com. How much time did you spend developing this trading course? I spent about 15 months, nearly full time. Did that impede your trading? Yes, hugely. But you still had your most profitable year by far. I know, but it would have been an even bigger year if I wasn't being filmed for the course. At the time of my biggest trade, the long Nikkei futures position during the August panic, I was scheduled to film in the middle of that week. Did you cancel the filming? No, I went. I cut a lot of my position exposure and flew out to LA to do the filming. Cutting your exposure, I assume, means giving up profits. Totally. I would have made millions more. What was the motivation for developing your trading course? It can't be monetary because, given the time you devoted to it, you could have made much more if you were trading. Just based on the example of the interference with your big Nikkei futures trade, doing the course probably had a much larger lost opportunity cost than you could ever recoup on revenue from the course. I viewed this project as having the potential to become the modern definitive guide to trading, and it's cool to create something beautiful and to pass on all your knowledge. Is it a matter of wanting to produce the best product of its kind? Yes. I wanted to use my knowledge and strategies to build a trading course at the highest production level possible. My video team has done work for professional sports franchises. My videographer has filmed the Grammys. I wanted to create something that would affect 100,000 plus lives over time. Another factor is that I'm trying to model for people that you can work hard to be successful, but ultimately, we all have a duty to the world, and we all end up happier if we help others. So the profits from the paid portion of the course will go to charity. If the object was to get money to charity, wouldn't it be more efficient to do it directly through donating trading profits? I could have made more money, but if I did that, would I have had the same ability to touch 100,000 lives and affect the philosophy of how those people view the world? The way to exert the greatest impact is through creating an exponential system. I do the same thing in my nonprofit, which runs competitions among college student groups to award funding to the best ideas for projects that benefit their local community. I want to impact the lives of 500 students per year, and I hope that those 500 students affect 500 people around them, and those 500 impact others, and so on, over the course of their lives. How does that giving back philosophy get imparted to users of your course? At the end of the course, there are videos where I talk about my philosophy and how I wouldn't be here if it weren't for all the people who helped me progress. I ask users who felt the course helped them to pay it forward, whether through mentorship, volunteering, or monetarily giving back. The other thing is that I get to interact with lots of people who have followed me via social media or my web postings. Hundreds of people have reached out to me and said, "Lance, thank you so much for what you do. You have changed my worldview. If I ever make it in trading, I will give something back." Do I know whether they will follow through with that verbal commitment? No, but hopefully enough of them will so that my cumulative influence will be meaningful. You're trading far less actively than you used to and holding positions longer. Do you feel you have reached a comfortable life balance between your trading and other activities? No, I am looking to move away from trading even more. Why? I'm very sensitive about health and longevity nowadays. I think of my dad passing away in his early 60s, and I don't want to just work my whole life and die early. I believe the trading I do is extremely unhealthy. It affects my sleep. If I have overnight positions, the second I wake up, I'm checking the market. As soon as I have consciousness, my thoughts are, what if a headline came out? What if the market is gapping down? What if something weird is happening? I was concerned that those underlying thoughts meant I never got deep sleep. I had sleep study professionals come to my apartment to conduct a sleep study over multiple nights. At the end of this study, they said, "Lance, aside from active military, you have the worst sleep results we have ever encountered." That was a big wake-up call for me. I realized that my trading had a negative health trade-off. How have you adjusted? I spend fewer hours trading than I ever have before, but I'm still not there yet. I'm at a point in my life where if I trade, it better move the needle. Those opportunities don't necessarily occur at convenient times and can take a physical toll. This past August 2024, I ran a half marathon on a weekend when the Nikkei panic occurred on Sunday night. I went all in, using a couple $100 million of buying power. I then proceeded to stay up the next 2 days straight and then had to fly out to do filming for my course. Did I make $10 million that week? Yes, but I also totally folded on my values. Staying up 2 days straight with my heart pounding is not healthy. When I'm involved in trading, I can't go to the gym and focus on the workout. If I'm at dinner with my friends and I have positions on, I won't be focused on dinner. I'll be thinking about what price my position is at and continually checking the phone. Trading comes at a real cost. Yes, the money for me in trading is great, but there's a fundamental flaw in always thinking about everything monetarily and letting money become the scorecard of your whole life. Our human evolutionary psychology drives us to stash acorns. It tells us more acorns are always better because they mean more safety and comfort. That is why when people start to view P&L, profit and loss, and money as their whole identity and scorecard, it's so hard to leave that game. I know many traders who, by any normal standard, have all the money they will ever need but still feel they can't stop trading. They'll say, "What if we get a recession and I lose 50% of my money?" Or, "I want to buy this beach house." They are continually moving the goalposts. I've seen people with 50 million still say they don't have enough money. What Bill Gates has done post-Microsoft is just as important as what he did at Microsoft, if not more so. Or consider Jeff Bezos. He held a high-paying senior position at D.E. Shaw when he decided to leave the firm to launch Amazon. I'm sure many people told him he was crazy to leave a lucrative job for a risky venture, a pursuit that would go on to change the world. Every rich person has an opportunity cost to do something else, but that doesn't mean optimizing for money is the right choice for them. Every time I've traded this year, it's been pedal to the metal, big trades like the Nikkei, and I don't wish to continue to do that to myself. More money will not change my life anymore, but being as healthy and happy as possible will. It sounds like your intention is to stop trading entirely, even foregoing big opportunity trades like the Nikkei. Is that correct? And if you stop trading, does that mean you stop following the markets? If you are still following markets, wouldn't you be tempted to trade at least occasionally? I wish I had great answers to these questions. The truth is that these are the exact questions I struggle with every day. Yes, it is my intent to stop trading, and I've tried setting boundaries on my trading, but I found it incredibly hard to do so. Those big, crazy market moves still fill me with fascination and awe. I've found it very difficult psychologically not to trade the events and make money when I have a view on them. The issue, though, is trading has an opportunity cost of presence, peace of mind, and the ability to have space to find the next chapter. Yes, I feel accomplished after these trades, but I also feel exhausted and beaten down and wonder why I still put myself in the boxing ring. It's a paradox. I suspect moving on from trading will be much easier when I know what the next chapter is that will fulfill me, make me happy, and, ideally, help the world. At the same time, it's hard to find that next chapter when you're immersed in the markets all day. Trading will likely always be the profit-maximizing path, but what if you don't want to do it forever? Athletes are lucky that physical aging forces them out when it's time. John Arnold, the famed natural gas trader, is an example of someone who left the money and moved on to do great things, much like Bill Gates or Sam Altman, who pivoted from Y Combinator and is now writing his greatest chapter yet at OpenAI. I look up to them as role models. I feel the same way about Brian Johnson, a tech entrepreneur who started a health movement that will have 1,000 times the impact of his prior business role. I'm very passionate about health and longevity, so that is something I will likely continue to explore further. I've learned a lot and attended seminars in this space. It's hard not to follow the markets, which makes it extremely hard not to trade. I can't bury my head in the sand to world events, and most of my network is full of traders. I do advisory work for a trading firm, SMB Capital. I'm tweeting trading knowledge. I struggle with all these aspects. Trading has been my whole identity and world for my entire adult life. Much like the experience of pro athletes, there are incredible highs and lows, and it's hard to replicate the excitement and dopamine fix of active trading. Part of the motivation for making the trading course was to pass on the knowledge as my trading legacy, then at some point, walk away. That was an important bookend for me to achieve in the process. How do you intend to spend your time if you stop trading? It has been and will continue to be a difficult process, and the transition will likely be gradual over time. Part of the issue is I don't know what comes next with my time, but I think trading was just my first chapter, and my greatest chapters are yet to come. If you no longer need your assets for trading, how do you plan to invest them? You only need to get rich once, and I never want to go back to not having financial freedom. A big chunk of my assets are traditionally invested outside my trading account. I'm a fan of passive indexing in the market and find it critical to minimize taxable events and management fees. My trading assets would mostly go into equity indexes. I also have life insurance, a debt lending fund investment, a real estate portfolio, and a heavy equipment business. I do the occasional private investment as well. I invested in Reddit before it went public, and I am invested in SpaceX, Equipment Share, and Figure AI. Is intraday trading like you used to do, programming hotkeys to shave a fraction of a second off your reaction time, living in front of a screen, a young man's game, or are there people in their 40s or 50s doing it? At Trillium, it was rare to be above 40 and still make money. One of two things happens. Either you are a star trader and make enough to retire early, or you're a good trader and keep trading as long as you don't lose your edge. Trading is a hard enough job so that you need to continually adapt and put in intense effort to still make money. What is it about you that you think explains why you succeeded so spectacularly in trading while most people fail? You can't reduce it to one thing. There are a lot of contributing factors. You need a level of intellect to understand the concepts. You need a passion for the job. You need a powerful why. I think for many successful people, their why comes from trauma, whether from their upbringing or something else. Having a powerful why was a huge factor for me. My upbringing gave me a certain level of grit and determination to succeed. Also, I had a video game background, and trading seemed like an elaborate game. Are you familiar with the book Atomic Habits by James Clear? I read it. That book is the Bible for me. It puts into words better than I could ever have done what I independently learned and believe, namely, you need to have an obsessive focus on the process. I can't control the outcome, but I can control my inputs. How can I make my inputs as efficient and effective as possible? I worked hard every day for all 10 years I was at Trillium. I went into the office almost every Sunday. Each day, I tried to get better. Forget about the P&L. If I lost 20 grand today and learned why I lost 20 grand and fixed that mistake, the expected value of my trades would increase. If I found a new hotkey combination, discovered a news catalyst, or learned something new, I improved as a trader. Every day, my sole goal was to improve and learn so that I could be a little bit better the next day. That's all I cared about. Yes, I recall that one of the key concepts in Atomic Habits was that if you could improve by 1% every day, the compounding effect would be massive. Correct. Trading is emotional, frustrating, and super difficult. Many traders quit early and go to the bar after a losing day. As a day trader, especially early on when I was terrible, if I were going to be frustrated and quit early every time I had a negative day, I would lose the opportunity to review my trades and improve on 2/3 of the days. I trained myself to use that negative emotion to fuel my work ethic whenever I had a bad day. On a good day, when I felt great, I would use that feeling to work harder. Regardless of whether I had a good or bad day, I was committed to staying and working. Most people who commit to something and don't see immediate results decide what they are doing isn't working and give up. I understood that the outcome is a lagging indicator of your inputs. My sole goal was to outwork and outcompete everyone in that office. When that work ethic is part of your identity, you can't leave early. You can't go home on a bad day. I knew how difficult it was. I knew the pain. There were days when I was so frustrated that I was on the verge of tears. I knew I had messed up. My boss was yelling at me, and I thought I was going to fail. I knew that if I felt this way on bad days, so did everyone else. I loved that because I knew everyone else who felt that way would leave the office as soon as they could. And that is how I would beat them. They were in New York City going to the bars for happy hour. They were having fun. I was in Princeton, New Jersey. I didn't know a single soul there. I was going to stay late in the office and work. I knew that was my advantage. If you were 22 years old and starting out in today's environment, would you do the same thing or would you do anything differently? I would still do the same thing, absolutely. There is this fear that the opportunity to get an edge in day trading will disappear, especially with AI. That was also the prevailing attitude when I started in 2011. People told me, you can't make money day trading. I then proceeded to make tens of millions of dollars. At Trillium, there was a top 10 awards ceremony. In 2011, when I joined Trillium, I think the 10th best trader made $800,000. Fast forward 14 years to now, and the 10th best trader made over $2 million, which is more even in inflation-adjusted terms. If markets were getting far more efficient and day trading was dead, the 2024 number should have been far lower. What would you say to a prop trader who, similar to your experience, is in their second year and still losing money? More important than your P&L is whether someone more experienced than you can tell you that they see you are improving. When I was struggling in my early days and had started interviewing for other jobs, I spoke to the number 2 trader in our group. He said, "Lance, I can tell that you're making progress. You'll regret it if you don't stick it out." It's not just about the P&L, which is a lagging indicator. Is your thought process improving? Are you making fewer mistakes? Are you doing a couple of things better? Are you getting less bad? Is the negative expected value of your trades approaching zero? When you were running the Chicago office, what % of the traders you hired succeeded? About 1 out of every 3 or 4 traders succeeded. Did the ones who fell out have any common characteristics? They didn't have the work ethic. They didn't have a why to work that hard. Some of them weren't coachable. If your coach gives you feedback, you need to be able to adapt and incorporate that feedback. Some people lack the ability to respond positively to feedback. They would become defensive or discouraged rather than use the feedback to learn and improve. Is there any other advice you have for aspiring traders that we haven't covered in this interview? Yes. Don't have any limiting beliefs. My mentor was very good about not having limiting beliefs as to what strategies he could do or the size he could trade. I had the mindset that if some trader was doing it, I could do it too. One of the main reasons so many traders fail is that they have limiting beliefs. They tell themselves, I can't do that strategy. I can't trade that size. I will never be able to make more than X dollars. Limiting beliefs will limit you. Coyle's take. What struck me most about Breitstein was his incredible self-awareness, his ability to be completely honest with himself, and in his early 20s no less. Most people don't reach Breitstein's level of self-awareness until they are much older, if ever. I believe this self-awareness was a big driver of his success. As an example of his self-awareness, when looking for his first job out of college, Breitstein was both pragmatic and honest with himself. He knew he wasn't a programmer or a math genius, so those paths wouldn't work for him. He also knew he was not interested in working in a suit and tie in a highly bureaucratic environment. Armed with this knowledge, he set out to find a place that would work with who he was while still allowing him the opportunity to achieve his goals. Also noteworthy was Breitstein's clarity on what he could and could not control. The one item he could control was his input, and he made a commitment to work harder than anyone else. He made this self-pledge measurable via his willingness to be the first one in and the last one out of the office. He adhered to his plan, regardless of whether he felt amazing or awful. An image of the Terminator comes to mind. Breitstein's willingness to prioritize and sacrifice to achieve his goal also enabled his success. While most 20-somethings wouldn't ever consider swapping the potential excitement of being young and unencumbered in New York City for a mentorship in Princeton, New Jersey, Breitstein looked at the bigger picture and made the choice that he felt would yield the greatest long-term reward. When we talked to Breitstein about his ability to take the long view at a young age, he said that strategy-oriented video games were an early influence. Breitstein explained that you win these video games by delaying gratification. This observation inspired a mental note to make sure my children play those games. It also reminded me of the Stanford Marshmallow Experiment, a 1970s psychological study on delayed gratification in children. In the Stanford study, various children were offered one small reward immediately or two small rewards if they waited a period of time. The study, and subsequent similar studies, found that kids who chose to delay gratification, i.e., 2 rewards later, wound up with better life outcomes using a variety of measurements. Breitstein lived in the delayed gratification camp, as evidenced by his willingness to forego a high-paying job for one offering only 1/4 the salary. This counterintuitive decision was easy for Breitstein because the low-paying job offered the path to achieving his long-term goals, whereas the high-paying one did not. He reasoned that he would be giving up $75,000 a year for the first 2 years, but then would have the opportunity to make up many multiples of that difference in subsequent years. Breitstein's willingness to spend hours every Sunday reviewing videos of his trades at different speeds to improve, akin to a football player watching game highlight reels, was something I had never heard of before. Clearly, he was willing to work exceptionally hard, and this characteristic brings us to Breitstein's primary driver, his why. Viktor Frankl was a psychologist and Holocaust survivor who wrote a book on his experience titled Man's Search for Meaning. Frankl quoted philosopher Friedrich Nietzsche in the book, who said, "He who has a why to live for can bear almost any how." To explain how this quote applies to Breitstein requires a brief digression. One of Sigmund Freud's contemporaries, Alfred Adler, wrote a 1927 book, Understanding Human Nature. Adler argued that something happened to every person in early life that made them feel terrible. This feeling motivated a primary life goal centered around making sure that they never felt that way again. Breitstein points out in the interview that his primary motivation was to ensure he would not struggle financially like his father did, and this desire to avoid the same suffering became his why. To achieve this why, and in line with Nietzsche's philosophy, Breitstein would suffer almost any how. Schwager's take. Many people are drawn to the markets because they think it is an easy way to make a lot of money, which is ironic because most highly successful traders are extremely hard workers. Breitstein exemplifies this trait. He was always driven to outwork everyone else. His commitment to hard work was a key contributor to achieving a near 4.0 average in college. During his trading career at Trillium, he was not only intently focused throughout the trading day, but he also stayed late each night to review his trades and do the necessary research to improve. He even recorded key portions of his live trading sessions to replay and practice his trading on Sundays. In fact, for Breitstein, being a hard worker was part of his core identity. In this respect, he adhered to one of the key principles espoused by James Clear, the author of one of his favorite books, Atomic Habits. In that book, Clear advises adopting an identity that will foster the actions you want to take. Defining his identity as a hard worker made it easier for Breitstein to take actions that reinforce this identity, working late every night, and avoid actions inconsistent with it, leaving early on bad days. There is, however, a downside to hard work when it extends into the realm of obsessiveness. When I give talks on trading, one of the traits of successful traders I mention is hard work. One of the examples I use is John Bender, a brilliant options trader whom I interviewed in Stock Market Wizards and who died at a young age 15 years ago. Bender specialized in trading Japanese options. After the Japanese trading session, he typically stayed up to trade European options and often continued to stay up to trade U.S. options. That routine adds up to something like a 20-hour day. I tell people that a common trait among great traders is that many of them are obsessive. I make it clear to the audience that I am only telling them what I observed and not recommending that is how they should live their lives. The two are very different. This trade-off between the time devoted to trading and the time available for everything else has become a dominant concern for Breitstein as he strives to transition to a more balanced lifestyle. Breitstein credits his mentor, the top trader in the firm, as being instrumental in developing his trading methodology and his ultimate success. This circumstance may seem to be a matter of luck, but Breitstein made his own luck by proactive actions that placed him in the position to be mentored by the firm's top trader. He also had the requisite skills to turn that instruction into profitable trading. He was lucky, however, that his mentor's methodology was a good fit for his personality and skills. In a firm like Trillium, such a match may be far more likely than is typical because everyone is a day trader in equities. Such compatibility, however, is often not the case, as there is no reason why the trading style best suited to an aspiring trader would be similar to a mentor's. The two could differ in terms of preferred markets, duration of trades, types of analysis, and many other factors. Great traders can adapt and change when circumstances require it. When Breitstein left Trillium and lost access to the technology that enabled super-fast trading, some of his primary strategies became obsolete. But he was able to apply aspects of his prior chart strategies to multi-day trades and, in the process, became an even more profitable trader. In recalling his first impression of trading, Breitstein describes it as playing a video game against the whole world and a super complex puzzle. These analogies reflect that, for Breitstein, trading was like an elaborate game, something fun that he loved to do, just like he loved playing video games as a kid. The comparison of trading to a complex game is something I have encountered interviewing other great traders. Bruce Kovner described market analysis as a tremendous multidimensional chessboard. James Rogers described the markets as a three-dimensional puzzle in which every day some pieces get taken away and others get thrown in. Successful traders love what they are doing, and speaking of markets in the language of games reflects that sentiment. Chart analysis is a potentially powerful tool, but simple chart patterns are insufficient. Breitstein suggests that one of the reasons academics fail to find an edge in technical analysis is that the approaches they test are not sufficiently nuanced. A pattern may not have an edge across all occurrences, but may be significant if accompanied by other factors. As a simple example, Breitstein notes that a price breakout is likely to be more reliable when accompanied by a significant news headline. Other factors that might be combined with basic chart patterns to yield more reliable market signals include daily bar patterns, volatility, volume, and price derivative indicators, e.g., moving averages, Bollinger Bands, etc. Risk management is an essential component of Breitstein's trading strategy. The vast majority of his trades have a predetermined stop exit. This stop tends to be very tight, below the low of the previous 2-minute bar for intraday trades and below the previous day's low for multi-day trades. On the infrequent occasions when a trade is implemented without a predetermined exit strategy, risk control is achieved by implementing the position in much smaller size. One Breitstein observation I found particularly incisive was, "Bad trades don't kill people, bad sizing kills people." One trading concept that can be useful to anyone is how Breitstein utilizes options. The basic idea is that if you want to buy a stock at some price below the market, options provide a more effective means of implementing that position. Instead of entering a good-till-canceled limit buy order at the intended price, you could sell puts at that strike price. If the market declines below that price and the option is exercised, your effective buy price will be better than it would have been with a limit buy order because you will have earned the premium from selling the option. But the real kicker is that if the market doesn't decline to your intended price, you'll earn the premium from the put sale. In either case, you would likely end up better off via the sale of puts than you would have been by using the straightforward buy order in the stock itself. The one exception would be if the market declined below the strike price and then rebounded by more than the premium collected before expiration. A similar concept could be applied to using the sale of calls as an alternative to shorting a stock at an intended sell point above the market. While setting annual performance targets may sound like a good idea, it can often have the opposite effect, driving performance away from the target. The market provides what it provides. Regardless of your trading method, some years will provide excellent opportunities, while others will be adverse to your trading style. The market doesn't care about your target. Breitstein's Avis trade provides the perfect illustration of this principle. There was nothing inherently wrong with this trade. He followed his methodology and stopped himself out when he should have. The fact that the trade ultimately resulted in a loss was not a mistake. The mistake was that because Breitstein was fixated on reaching a $20 million profit target for the year and time was running out, he placed the trade in a much larger size than he normally would have, resulting in the largest loss of his career. Ironically, his target directly caused him to fall short of that number by a greater amount than he would have otherwise. Breitstein notes that a critical question is, are you playing the right game? In his case, he did extremely well as a day trader, but discovered that he could do far better with much less time commitment by extending his approach to multi-day trades. The lesson for all traders is to be open to the idea that your methodology may not be optimal for you, even if you are profitable. There's more to life than trading. Pure monetary optimization may not be the ideal path to living the best life possible. As Breitstein proposes, living a balanced life while giving back to others might be more fulfilling.